Hey, everybody, and welcome back to another episode. Today, I want you guys to meet Brady Slack. He is the financial mastermind behind High Country Finance. He's the owner of his full service tax and accounting firm. Brady's mission is to help people experience true wealth while minimizing their tax burden. Years of experience under his belt, he's consulted with hundreds of investors and entrepreneurs, sharing his knowledge and expertise to help them increase their revenue, decrease their expenses, and save on taxes. It could not be a better time, because right now is when everybody's getting worried about taxes. So I'm excited to talk to this man today. Brady, welcome to the show. It's great to have you on.
Brandon, thank you for having me on. I'm excited for the conversation. I'll make one correction. Now's a great time, but like they say, the best time to plant a tree was 20 years ago. So,
Yeah,
that,
100%. And it's kind of funny. I had such a nightmarish experience once with my taxes that I,
yeah.
I have a reminder on January 1st to reach out to my accountant and start the process. I let one go, and then I hired a new one, and
Yeah.
she kind of has things running a lot smoother. But hopefully we can help people avoid some of those nightmares and avoid giving the government some money. For those in the audience that don't know a lot about you, why not give us a synopsis on your background and your story, and like, why are you passionate about what you're doing today?
Well, I'm going to be honest, and I don't know how many of us there actually are, but like I didn't grow up saying I'm going to be a tax advisor when I grew up like that.
When you were a little boy?
That sounds boring. No, to be honest with you, I got tripped and pushed into taxes, and then I kind of fell in love with them. I wanted, when I was younger in college, I knew I wanted to make a lot of money. I'd always heard, accounting is the language of business, and figured, okay, great. If I did, business is the quickest way, in my opinion, to be able to make a lot of money and obtain wealth. So maybe I'll go into business and I'll study accounting rather than business management. So that's how I got into like the accounting, if you will. But then while I was in college, my now father-in-law had a good accountant and was like, hey, they're looking to hire. Just so happened they were paying more than where I was working at the time, which was a real estate firm. And it's like, okay, great. I'm going to go get some experience there. And very quickly worked my way into an advisor position with some of the education that I had at that time. And
Mhm.
again, that was kind of, my now wife, she tripped me, my father-in-law pushed me, and then I kind of fell in love with it as time went on. And then, yeah, I was in a unique situation where I worked for a smaller family office. So right off the get-go, I was working with individuals, high net worth businesses were doing multi-million dollars. Some of these guys were taking home 1.5 to $3 million a year with some significant asset classes, whether that be a syndication fund model or their own portfolio of single multifamily. A lot of our clients were getting into kind of the speculative stock space with some private investments. They were doing mobile home parks in the Midwest. So I saw these different asset classes, and I was kind of exposed to them early on, where it provided me with a lot of really good understanding of how the tax law works, the ability to use the tax law to your advantage, and how to kind of game that system to make more money and hopefully pay less in tax.
Okay, so it sounded like you got I loved how you said that you got tripped and then kicked into it by your parents, it seemed
Yeah.
like. And it sounds very fortunate to work, kind of under a family office. You got some great exposure to high
Yeah.
net worth individuals. Sounds like real estate was kind of the thing that you sort of cut your teeth with and stuck with. I'm curious because I want to jump right into it. I know that there's 2 weeks left in the year. It's on everybody's minds. Oh my God, what am I going to do if I haven't prepped this year? I'm going to have a tax bill. Real quick, what are some tips and tricks that you recommend to your clients, business owners, that you got a few weeks left in the
Yeah.
year? What would you recommend them do to try to minimize their tax burden? Maybe if there's some like low hanging fruit
Yeah.
or some stuff that's maybe not as widely known.
I think that at this point in the year, and this is, I'm going to say this, but it's a double-edged sword. Deductions are going to be the biggest or the most easy way for people to pay less in taxes.
Mhm.
Obviously, the more deductions you have, the less in tax, the less income you're going to report, and the less tax you're going to pay. That also goes without saying that when people come to me, the end of November into January or into December and say, what do I need to spend money on to save some tax money? I go, well, do we really need to spend that dollar? Because really, when you spend that dollar, you're only saving 24 cents in a tax, but
Yeah.
now you don't have that dollar. So in some instances, I would almost rather you give the 24 cents to Uncle Sam, keep the 76, because then at least in the future we can go do something with that 76 to make more money. Again, a little more oxymoronic, but at this point in the year, a lot of things are going to be what can I spend money on and get a deduction, but maybe not have that money leave my financial sphere or my control.
Mhm.
Paying my kids, a qualified plan, like a defined benefit contribution or a SEP or a solo K. We might be looking at things like reclassifying some expenses based on technicalities for board of director meetings, Augusta rule expenses, things like that that we might have already spent money on, but did we really use it to help our business? Did it have a business purpose? Do we have some sort of documentation for it? And can we add that as an expense or a reimbursable expense so that we can report less in income? But like those are a couple quick, easy things, I think.
I love what you said there. I mean, those are very low hanging fruit.
Yeah.
Rewind it and write down everything that he said, because that reduces your tax burden and it allows you to keep control of your money. The stupidest things I see are people who go out and will just spend money for the sake of the
Yeah.
deduction and they don't actually need it. And it's just the
Yeah.
dumbest thing I've ever seen.
And I get it. I think a lot of accountants really have the best interest for their clients at heart, but like, do you really need a new vehicle every other year?
Yeah.
Yeah, I know you don't. Do you really have to go buy a new watch every year? No, you don't. So like some of the things where it's just like, are we getting money to get money off the books, or are we spending money because it actually is going to help our business in the future? Like that's the question.
So my brother called me because he's having a tax problem. In fact, I'm probably gonna send him your
There
information
we
after
go.
this. Now that I think about it, because he needs a tax strategist. He thinks like accountants equal tax strategists, and I'm like, no, that is not the case at all. Some accountants just want to do your taxes and that's it. Others
Yeah.
work within specific niches and actually have experience working in that niche to help those specific business owners or businesses like reduce their tax burden, come up with
Yeah.
strategies. And he's definitely in that boat. I'm curious. He hit me up, and this is a question for you because I don't know this, and I was trying to brainstorm some ways for him to reduce. If he's a contractor, he owns a concrete construction company. If he were to go and buy a piece of equipment for his business, because he
Yeah.
does have like a mini X that he's like, I'm having to replace a lot of the stuff. I think it's to
Yeah.
the point where I might just want to go buy something new. Rather than him spending the full cash out of his pocket outright right now and just buying it and getting that deduction, can he get the same deduction if he bought it but took out a loan and put a liability on his balance sheet?
He absolutely can. And I would argue that that's probably a smarter move than taking the cash out of your bank and purchasing it outright. Yeah, that for the same reason in real estate, it's not always smart. Again, very situational. It's not always smart to just go buy a $250,000 condo as a rental property with straight cash. No, I want to keep as much cash as I can. I want to leverage other people's money, and I want to be able to use and leverage as much of my money as I can to help me get the highest ROI that I possibly can. So no, I like in that situation, I would say it's no different than you going to purchase an apartment complex or a single family home. No, I want to leverage the money. I want that money in my bank because then I have the ability to go do more things with it,
Hmm.
spend more on advertising, invest more in human capital. Like
Hmm.
that gives me a lot more opportunities. And then you always take into consideration the universal law of time value of money. A dollar today is worth more than a dollar tomorrow. But if I don't have a dollar tomorrow, it's going to be worth even less.
I love that analogy. Now, we covered some of the short, low-hanging fruit, like, it's the end of the year. What are some quick kind of hits that I can get, some quick things I can do? Let's say we've got time. It's January 1st,
Yeah.
and you're setting up calls with your clients, and they're wanting your advice. What strategies are you advising your clients to use to minimize their tax liability for individuals and businesses?
Geez, Brandon, how much time do we have? Um, the I think a kind of a better way to look at this is define so the IRS and a lot of other tax agencies, whether it's local, municipality, or state level, right, federally included, they have two goals. They need to raise revenue and they want to incentivize activity. And if you have ever read like Robert Kiyosaki's Rich Dad Poor Dad or his cash flow quadrant book, he highlights who pays the most amount in taxes using that cash flow quadrant: employees, small business owners, big business owners, and investors. And the reason that your business owners and your investors pay fewer taxes is because they adhere to the second goal that the taxing authority has, which is incentivize activity. The way that governments incentivize activity is through tax law, right? So if you look at the tax law as it's written right now with the Inflation Reduction Act that was just introduced a year and a half ago or so, and all of the revenue rulings and opinion letters and whatnot, our tax law is well over 7,000 pages. Okay. But what's interesting is really only about the first 30 of those pages tell us how much tax we have to pay, when we have to pay it, and what we have to pay it on. The other 6,970 pages are kind of like a roadmap or a directory for the many different things that we can do that align with their second goal of incentivizing activity,
Mhm.
creating housing, creating food, providing a good, providing a service, right? And so when we understand that, it's a little easier to have the conversation of what are we doing with our clients to help them plan, right? Or what strategies are we using? Because all of the strategies are aligned with one of those two things. Oftentimes, our clients are business owners. So the first thing we're looking at is how can we reinvest some of our money back into our business? Because that's going to be the biggest growth opportunity for us. It's going to have the most value and it's going to give us a quick ROI.
Mhm.
And how can we provide more value in our business, right? Reinvesting into human capital, advertising, marketing. How can we grow? What products and services can we add through value?
Mhm.
The second place again is we're going to look outside that box. Are there other businesses that I could go and acquire? Are there energy investments that I could make? Whether again that's on a personal level, like putting solar on my home, does it financially make sense? Or are there syndications or funds that are going to get me good tax credits with some ROI? Right? Oil and gas is a really good investment from a tax standpoint because of intangible drilling cost expenses. And then obviously, a lot of my clients are invested into real estate. That's an easy one. It makes me really good because, or it makes me look really good because real estate's an easy tax strategy. And in my opinion, it's one of, if not the best tax strategies if we do it right, because of depreciation and cost segregations and real estate professional status and things like that. So
So
that's kind of just an example set.
I love it, and that's why they pay you to go read the 6,970 other pages so they don't have to, and they can
Yeah.
save tens of thousands, if not hundreds of thousands of dollars. Let's take a step forward. I'm curious. So I'm a real estate professional
Yeah.
status. We do development. I was telling you on this call how we develop land. We'll sell that land to builders. We'll rezone land. We build houses, mostly single family entry level homes. We're trying to get into this build to rent space to
Yeah.
capture some of that depreciation. The way I'm set up right now is my partners and I, we all have S corps,
Yeah.
and we have multiple LLCs. So every syndication we do is owned by kind of like what I call a mother fund, our
Yeah.
HBG fund management entity. And then our S Corps own that. And then we've also got a construction company and a acquisitions and holdings company. And the way our accountant set us up is all of those entities are owned by our S corps, so all the profits or the losses kind of flow up in those S corps and kind of blend together. I'm kind of curious, do you use a similar structure with some of your other clients that do real estate syndications or have this real estate professional status, or is there some other strategies that maybe we don't know about?
I would say it's fairly similar, but there are some differences that I, again, situationally would advise differently on. Yeah, for all of our clients that have some sort of active or operational business that they're involved in, the proceeds are subject to self-employment tax. We do integrate some sort of S corporation or management company in that structure, whether it just be that company or they're a partner in another company,
Okay.
right? Because we want the tax savings from that active income through the S corporations, right? That's an easy tax strategy to take advantage of so that I don't have to pay more in self-employment tax than I should. Okay. However, when we get into asset holdings, rental properties, maybe alternative investments or syndications, whether that be it I'm a GP or I'm an LP in the syndication or the fund, we separate that out from the S corporation into a holding structure with LLCs. Now, there's a couple reasons why we do this. One, I don't like real estate to be held in an S corporation if it's for holdings, because if I transfer, I sell, I exchange any of those assets, I do have unintended tax consequences because of the stock basis in my S corporation. And so I transition those out into an LLC, and those are separate. Now, obviously, people then have the question, well, how can I invest more into real estate if it's not through that entity? Well, I take my distribution from my S corporation and I push that as a contribution into my holding company to invest in the property. That's an easy transfer, right? Um, that's a typical active passive side of the aisle strategy that we use, and I would argue, everyone should kind of have foundationally for them. And then depending on the situation, we're always integrating maybe a trust or a series of trusts for estate planning purposes, or I like land trusts are really big on social media. There's some financial porn out there, but they're really big and they do have a place in that structure. So that's kind of the basis of how we're structuring our clients' entity or organizational maps.
When you hop on these calls with newer clients,
Yeah.
and I'm sure you probably do some kind of evaluation. What are some of the biggest aha moments that you see that them have? And what are some of the biggest mistakes that you see business owners making?
Geez, that's a great question. So I think it was maybe a month and a half ago. I'm in a business group, and on one of the Facebook pages of this business group, an individual asked specifically to the 7-figure plus earners, how do you become the financial expert in your businesses, right? And I thought it was actually, I think he was trying to, I think there was more that he was trying to get at,
Mhm.
because as a business owner, Brandon, like, your expertise is not tax. Your expertise is the deals that you're doing, the building, the development, the real estate, right? That's your expertise. And you've spent a lot of time doing that. And
Yeah.
so for a lot of people, a lot of the principles that like we talk about with our clients, they're not common knowledge. You might see something on Instagram or TikTok and, have questions about it, but it's not like how it works, because quite frankly, they're never taught. And so for this individual, the response that I gave him was, you shouldn't be that financial expert. I don't want my client to be that financial expert, because they don't make money doing that. They
Yeah.
make money doing something else at whatever they're the expert at. So my recommendation is, find someone who understands what you're doing and create a partnership. Yeah, our best clients, the ones who continually increase in profitability, and the ones who, quite frankly, continue to pay the least amount of taxes, view me and my team as partners. They have constant communication with us, and we're able to dissect their situations and help them understand situationally what they need to be doing, what investments they should be making, how they should be viewing their money, and what they should be doing with their money to make more money and pay less in tax. So I think the biggest like aha moment that our clients have is, once they kind of take that leap, and it's an investment. It does cost a little bit of money to have that sort of relationship with your accountant, but once they're able to do that, then they're able to see, okay, great. I don't need to know everything, but I do need to know what's going on. And I need to work with this person. And that's kind of the biggest aha moment, is that things start to click.
Mhm.
And once they start to click, it's really dangerous, because now they understand what's going on to a degree, and they can make decisions on their own and then come back to us and confirm. And it's really fun for me to see that with some of our clients.
Yeah, it goes back to that who not how concept. You don't
Yes.
want to be the one trying to figure that out. Figure out what your unique ability is, what
Yeah.
you're really good at, and try to outsource everything else. I've
Yes.
learned that lesson the hard way multiple times.
Right.
Multiple times. Luckily, I never tried to be an accountant because I do not like the whole accounting side of
Yeah.
things. Like I like numbers, but I like putting numbers into deals and seeing what it
Yeah.
spits out at the end. What's that net
Yeah.
profit look like? How much money are we gonna? Those are the types of numbers that I like doing, not
Yeah.
necessarily the tax stuff. I'm curious, when you're working with a lot of your uh, clients, what are like what are some of the best resources that you can give them? Because I know they're going to want to a certain degree, they're going to want to learn a little bit, right? Enough to
Yeah.
kind of scratch the surface, kind of understand, where they need to be playing and where they should be looking. Like, how does somebody who doesn't have a lot of knowledge on this subject get resource access to what they need to know?
Yeah. Okay. Really good question. So this is a hard one because I am going to give some social media outlets that people can follow that are not my own, because there's some actually really good content that gets put out by individuals that I think are important for people to understand. One guy on social media, his name is Edward Collins. He does people send him videos to ask him questions, and then he reviews the video and then tells what the technical references are in that video. And I think he does a really good job. Tom Wheelwright is another one who on social media does a very good job, and he has a podcast called Wealthability.
Hmm.
He has two books. He's actually a really good friend and mentor of mine. He has two books: Cash Free or Tax Free Wealth, and then the Win Win Wealth Strategy, that are really good books. I think most people should probably be careful with a lot of other people on social media. At least in my opinion, if you see something that you like, you save it, have the conversation with your accountant and ask how can this apply to my situation, right? Because then you can actually get some situational good advice. Don't just see it and then do it, because it might not always work for your situation. Some other ones are like Bloomberg Tax has a really good content library, lots of really good resources. And then so like the Accountancy Journal, AICPA, and I think anyone can go on to those websites and use the search functions to search specific tax law questions or situational questions or entity questions. And then again, like I said, the most valuable asset you should have in your tool chest is your advisor. So
Any changes to the tax laws that have happened over, the past, couple of years, few years that maybe people have not heard about that they should know about? Because I know that's one of the value plays with,
yeah,
using somebody like yourself, as y'all know about the changes and when they happen and can capitalize it, like when Trump was in office and he put that into place where you could forward,
yeah,
depreciate a lot of the real estate benefits. And I think the law changed like last year or this year. I think it's like up to 80%
yeah.
depreciation on assets instead of 100%. So being top of mind is very, very important. It's a huge value play. I'm just kind of curious if there's anything kind of big over the last few years that have happened that maybe you want to share with the audience.
Well, it's actually funny, Brandon, that you mentioned the depreciation, because as you were asking the question, that was the one that came to mind. In fact, I was on a call with an investor yesterday who was asking about this. So with the current tax law, there's a step down to or a phase out of the bonus depreciation from 100% to 80% in 2023, 60% in 2024. And then if there are no additional changes, after January 1st of 2025, it steps down to 50% indefinitely. Another one that I think it's not necessarily this actually happened, and this bill was passed. This Corporate Transparency Act was passed maybe 2 years ago, but now people are starting to worry about, because now everyone has a benefactor report that has to be filed through FinCEN starting January 1st. And so that the Corporate Transparency Act and the benefactor reports for all businesses are something that people should definitely be aware of and get with their advisors on what information is needed to file. But we're also kind of in this weird time period where next year's an election year. You could say the Democrats would probably want to push some sort of tax law to try and get the votes next year, but the House controls the Congress. And so the odds of the Democrats being able to push a tax bill through, in my opinion, are slim to none. And then if we get a new president, or even if President Biden is reelected, odds are, as you would expect, a new tax reform either in quarter 1 or early quarter 2 of 2025. It's fairly typical. We saw that when President Trump was elected. So, anyways, those are some things that are changing or have come up, but I don't anticipate within the next 12, maybe 18 months for there to be huge tax reform happening.
Okay. Awesome stuff, man. Dude, Brady, this has been eye-opening. We've covered a lot of
Yeah.
great tools. I'm going to do my best to try to go through and post a lot of the recommendations here that you've got, because I mean this is gold. I mean, literally in what he said today, there's tens of thousands of dollars of saving, if not hundreds of thousands of dollars
Yeah.
for some individuals. So if you haven't already and you don't have a tax strategist, now there's a difference between an accountant and a tax strategist. Your accountant is not a tax strategist. You want a tax strategist. If you haven't booked a call with Brady or anybody for that matter, just book a call with somebody and get an evaluation. Brady, for those listening that want to get in touch with you, learn more about you, learn more about your company, where should they go?
Yeah, thanks, Brendan, for that. The easiest way to find me is on social media. So either through TikTok, Instagram, X, LinkedIn. You can look up my handle is at the Brady Slack. You can go to our website www.highcountryfinance.com. Any calendar links you can find directly through there, so that you can hop on a call with someone from my team, and we can definitely help you.
Rock and roll, and we'll try to make those posted in the show notes. My friend, this was a pleasure having you on today. Thanks for stopping by.
Yeah, thank you, Brendan, for having me. I appreciate it.